Welcome to your Wealth by Design, a low-stress, systematic approach to investing. This is my attempt to build that system. This content is for entertainment and informational purposes only. This is what works for me and may not be appropriate for you. I'm not a financial advisor and this is not financial advice, so please do your own research before making decisions with your own money. Looking at the performance on the day, we are up 0.14% on a day when everything is down. The world index is down 0.33%. The S&P is down 0.51%, and the QQQ is down huge, 1.75%. Quickly looking at performance year to date, we are getting a chance to catch back up. We are only down 1.29% versus the world index, the one to beat, at 2.13% up, the S&P up 0.42%, and the QQQ has gotten rid of all of its gains and is now red for the year at minus 1.2%. Looking at the day's top performers, silver continues to rally slightly, energy is up big, materials up big, real estate, money flows in, money flows out. I don't know if it's going to stay, but for today it's up, and Japan up big. Healthcare finally seeing some love, up almost 1%. Looking at the day's biggest losers, Ethereum and BTC continued their decline. FTech is starting to establish a significant downtrend, and communications also down. Emerging markets, that's your semiconductor manufacturers mostly, are finally starting to follow the tech companies that have been trending down. Consumer discretionary is down. I think I saw Tesla down big today, and utilities down. Let's take a look at our target weights and see how they perform today. Remember, the target weights indicate a trend, not that the trend will outperform, just that it will continue the trend. So our biggest trend is continuing. We've got consumer staples going up. We've got energy going up. We've got international mid-caps going up. We've got industrials flat, and we've got Japan up. Let's take a look at the general direction here. So 3% is currently our catch-all for low to no trend or negative trend. So if we look at just 4% and up, the majority of them are green. So our model recognized a trend and the trends continued, which is why we outperformed today. And then when there was no to negative trend, they're gonna do all kinds of things. And we've got maybe like looks like it's mostly red, but some green in there, just random things going on, fluctuations. I am curious what is moving healthcare. It's a sector we rarely look at. Well, that'll do it. Eli Lilly top holding up huge today. Wow, Eli Lilly's revenue is up 43% year over year. They just reported their earnings and they beat surging GLP-1 demand. The combined sales of the weight loss drug Zepbound and diabetes treatment Mounjaro reached $11.7 billion for the quarter, outperforming expectations despite price pressures in the US. They also provided bullish 2026 guidance. Novo Nordisk issued weak 2026 guidance, and that is their main competitor. So Eli Lilly up huge. I don't know if that trend's going to continue for healthcare to establish an overall trend, but it'll be down. And healthcare down huge. The majority of these holdings are down. Top 10 holdings make up 50% of the fund, and Eli Lilly is pretty much carrying it entirely. No, Amgen up as well. Amgen also interesting, up almost 8.25% today to hit 52-week all-new highs, closing at 366-ish. They beat on their earnings, 9% year-over-year growth in revenue, driven by double-digit volume growth across its portfolio. And it also provided strong 2026 guidance. Take a look at the model. Markets are extremely uneasy today. Fear and uncertainty are reasonably high. That's bringing down our DCA down to $165 a day. That's quite a slowdown, down to 0.33% of our savings. If we look at the trends that QQQ and the S&P are establishing, they are strong negative trends, and they could just violently snap back for some reason. But if things continue as they are, they're going to go down quite a bit. World index is still in a positive trend, a relatively weak trend, but a positive trend nonetheless. If we look at what got moved around, emerging markets is giving up strength, falling lower in our relative performance score, and Pacific ex Japan is increasing. Yeah, that's a decent trend. US mid caps starting to trend. Gold's still holding on. Gold is in a decent trend. Volatility is very high, so it's being punished because of that. But gold's trend is not entirely broken. Silver is still pretty broken. It's floored at the lowest possible value. Tech sell-off is huge. Third strongest negative trend that we are tracking. Taking a look at our broken trends, we've got FTech, which is is that's not good. So on the short term, extremely down, and on the long term, starting to go negative. Who knows what tomorrow holds? Our model will adapt, but it looks like this trend is going to continue. Communications also showing a big move down on the short term and the long term, likely to continue. Well, we already have them as the smallest holdings in our portfolio, so we're protected from those downtrends. Emerging markets is a little higher. On the rebalance, that's going to come down, maybe 4. I don't think it's going to go as low as 3, but we'll see. We have quite a few negative trends. As most of the market becomes more volatile, we will go more equal weighted. I mean, we're already pretty equal weighted as it is. Go ahead and recalculate and see what things look like. Where did emerging markets end up? They ended up in the loser pile. All of tech seeing a huge sell-off, but it was slow enough that our model could adapt to it. We're not really experiencing any tremendous pain as a result of it. Consumer staples stays at the top, no increase or decrease. Energy is getting a bump. International mid caps has sneakily made it to the top here. Let's see what's in there. If I remember, it's going to be a bunch of companies that I don't really understand. It's going to be a lot of financials and industrials, and I can't click through on them, so they're really annoying to research, but let's just check the top few. Yeah, I don't know. I don't know what's causing international mid caps to move, but the top 3 holdings are either negative or flat. So this fund is relatively well diversified. The top 10 holdings is just 8%. I don't know, somewhere in this jumble here, but a trend nonetheless. So we will follow it. Just interesting to see how far some of the top winners have fallen. Gold and silver are slowly recovering. Got silver here, was like a negative 17 trend the other day. Now it's a positive 4. And where did gold go? Gold is doing really well. Gold is up here, almost about to make it to the top 50% of the holdings by weight. Gold is making a recovery. Emerging markets being dragged down by AI tech sell-off, and the rotation is seeming to stick as we rotate into defensive trend. Taking a quick look at the relative strength versus the benchmarks, 86% of our portfolio is above the QQQ and S&P trend. Their trends are negative. Majority of our portfolio's trends are positive. What is moving up tends to continue moving up, and what is moving down tends to continue moving down. So I expect tomorrow to be a very good day for our portfolio. There could be a sharp reversal in these holdings, QQQ and the S&P. We'll see. But either way, the only thing our model struggles with is fast moves, because we trade once a day and we wait till the end of the day. So we basically trade every morning and we wait to see what the market looks like at the end of the day. So if something moves violently up, we're going to miss that. But the upside to that is that we do not chase false trends. Any significant move up or down, our model's not going to react to that unless it's a continued trend. Let's go ahead and update the target allocations. I updated the target holdings. Now we're going to check to see if the actual holding size is twice the size of any of the target weightings. If so, we'll trim it back down to its target weighting. Emerging markets will need to be trimmed down to 3%. FCOM will need to be trimmed down. Looking at the total gains of each individually, it looks like they will more or less cancel each other out. So we're going to trim this about 4%. Which was up 1.25%, and FCOM we're going to trim this about 3%, and it was down 2.3%. Still not entirely sure if our profit taking threshold is ideal, but we'll continue to see how it performs before we make any changes. I'm trying to think under what circumstances it would harm us. If we look at our current model, the emerging markets trim makes sense. It was profitable, the trend is decelerating, we capture the gains, makes sense. FCOM, on the other hand, we are trimming and it's negative. How did we end up having so much in FCOM? If we notice, our allocations have gotten more aggressive. They were all 3s towards the bottom, and this I think was like 10. If more holdings are in trend, that means there's a healthy market. Yes, there's turmoil and it seems like it's the end of the world in this particular part of the market, but the rest of the world is showing other trends. So it's not like everything is on fire. And because of that, the model is recognizing that the market is healthy and trends exist, and relatively this trend is 6 times a greater opportunity than these trends. Now, FCOM has been somewhat volatile, but not more volatile than average. If it's green, then it's less than average. If it's red, then it's more than average. So not extremely volatile, just a negative trend. Let's not overreact just yet. Let's continue to observe. We don't want to over tune the model to fluctuations or one-off moves. If on the whole it works, then we'll stick with it. So we'll continue to watch it and see how that plays out. Today's a relatively short video. The debasement trade is largely unwound, but the underlying assets still have value. The market can't decide whether or not that trend needs to continue. The institutional AI players feel threatened by some of the AI startups, so we're seeing some sell-off there. But if that were the case, then I don't understand why the chip manufacturers would be selling off. The emerging markets, there's still a trend. It's moving down though, so they are selling off, which makes sense. If someone's winning in AI and we need chips for AI to work, well then I'm not sure why it would be down. Even if smaller players like DeepSeek are able to demonstrate a reduced need in training for chips, there's still no denying, well, no, that's not true. Yeah, I was going to say there's no denying the need for inference, but there has been, I don't know if breakthrough is the right word, but there has been adaptation in the business sector using on-site processing for inference, which may be calling into question the need for these huge inference build-outs. But the average person using AI is not going to have, well, that's true. As they refactor the models, they can get inference down significantly. I'm not sure how things are going to play out, and I'm not sure what it's going to be. Every day I say the same thing. There's far too many moving pieces, and the world is far too complicated for me to try to pretend like I understand what it's going to be. But that's okay, because the model uses the wisdom of the crowd to determine what the trend is. It's very hard to determine what it's going to be. I have no clue, but I can clearly see what the trend is, where it is and where it isn't. And the longer the trend, the more we stand to benefit. The shorter the trend, you know, we may miss some micro trends. If there's a jump for earnings or, you know, a rotation for safety or fear or flight to safety or something like that, I'll be slow to pick up those, but to be fair, those aren't really trends. Those are just movements. The model does not pick up every movement in the market and capture those gains. It looks for trends and it buys into those trends. And the strategy is working for now. So, like I always say, the experiment continues. I appreciate y'all stopping by, and I will see y'all tomorrow.